Hello there everyone, welcome back to another video. Today we're going to be discussing how to choose the right PD arrays, specifically on the higher time frame, but this is also going to be applicable to the lower time frame as well. Probably one of the most asked questions when it comes to ICT trading is which PD arrays do you actually use? Which ones do you reference in your trading, right? And how do you actually know that the PD array that you've chosen is going to provide support or resistance for price? Well, I'm going to share with you a simple approach to how you can actually objectify this a bit more and not just solely rely on any single PD array that forms and just hope that it works, right? Because we want something that's objective and that we can look for every single day and have confidence in. So to start and just to explain the main premise of the way I'm going to be showing you this is when we look at PD arrays, I like to use PD arrays that have formed on the left side of the curve and have previously been used. Now, when it comes to choosing the right PD arrays, right, what I would want you to take away from this video is that we have to see our PD arrays get referenced by price before. So what I mean by that is I want the PD arrays that form on the left side of the curve to be either displaced and then used as a resistance or support for price to go higher or lower. Because when you see that, when you have a PD array that forms and price is showing to you that it has an interest in this PD array, it's clearly showing you that this is an area of interest, right? Because it's referenced it before, it's used it to go higher or lower. And that's the kind of PD array we want to use. And of course, there are exceptions that we can apply, specifically when it comes to the lower time frame. And maybe you want to base your entry on a newly formed PD array. That is also valid, but I'm going to show you when you should do that. So just to showcase kind of what the point is, I've gone ahead and chosen a SIBI right here. And you can see this SIBI, right? It's the first SIBI of the leg that took out liquidity, and in this case it was quite a sharp move, so this one took the low on the same candle, but you can see it also wasn't the one that took these lows down here. So this is the first imbalance that caused a liquidity sweep down here, and that's something I want you to keep in mind, is that imbalances that form, the very first one that forms for a run that takes out liquidity. For example, we have another one right here at 9 o'clock. This imbalance is the first one that formed for a run that took out liquidity, took out the highs. These are important to monitor, and especially then when you combine them and you reference them at a later point in time. For example, right here, this imbalance, this SIBI, price comes back into it, finds resistance, uses it to go lower. Once again, comes back up into it, finds resistance, uses it to go lower again. And what do you expect then when we close above it? When you see that price closes above the imbalance and retraces into it, you anticipate it now to provide support. And that's exactly what it does right here. And so then when price comes back into it, once more, finds some support here, goes a bit higher, and then ultimately drops down to the very edge of this imbalance, but you can see it did not close below. This is a very strong sign because we want to see it function as support, and this means to not get displaced below. So it's finding support here, goes higher again, closes above again, and then closes inside of it once more. You get this long rejection wick, but you can see price did not close below it again. So we still anticipate this area to hold. And you can see clear closure above again, retracement, another move higher, taking out liquidity, completing this market maker buy model right here. Example number 2, up here, as you can see, we have this imbalance right here. Let's say you're watching the markets on Tuesday and you're wondering which array should I choose. You have to look to the left of your chart and you see, okay, I have an imbalance here. I see that this imbalance has been used by price before to go higher. I mark it out, because you know that if price comes into it, you can see here, it closed below, but then it closed back above again. So then when price retraces into it, you anticipate it to function as support. to go higher. Of course, it's a bit more messy when you close below like this and then instantly close above again, but you can see that price still respected this area. It did not use it as resistance once it had closed below, and there was a buy setup down here with SMT. So clearly price did not want to go lower here. So same thing then for the next day on Wednesday. We still have that same point of interest marked out. Price goes into it here, uses as support, same thing again, exactly the same setup. Displaces above, retraces into it. Perfect. If you didn't catch this entry, you could catch it here, and then goes higher, completing this market maker buy model here. Another example right here with this imbalance on this side. As you can see, this was the first imbalance that took out this liquidity. And yes, it was in the same candle. It just shows that it was quite a strong move, but it doesn't matter. We're still going to monitor it. And of course, it was still a big imbalance. So you can see price kind of took its time inside of this one, but ultimately it did respect it, finding support towards the end, goes higher, but then goes and drops lower again. So this means once it's reached again, what do you see right here at 5 o'clock? Price touches that imbalance once more after having closed below it, so that it now should function as a resistance on price. It does, and it goes down to our other imbalance down here, which then uses it as support on price. It then goes higher, displaces above the imbalance once again, and we know that this is an area of interest, so price retraces into it here at our time of interest around market open, finds support, goes higher. Same thing again today. Price goes into it, finds support, then moves higher. Do you see how we have to monitor the left side of the curve to understand what our points of interest are going to be on the right side of the curve, right? We cannot just simply use any newly formed imbalance. I want you guys to focus on the ones that have already been used by price. And this also counts on the lower time frames. If you go on the left side of the curve on the lower time frames, you can also find this same occurrence, except there's going to be a lot more of them, of course, as we are usually on the 1 minute on the lower time frame, or even the 15-second or 5-second. So you will see more of this, and that's why I prefer to say that you should use this as a point of interest for the higher time frame, maybe even a draw on liquidity as well, combined, because as you can see, it works quite well. Just wanted to show another very precise example and why you use the first imbalance that forms on a leg that takes liquidity. As you can see right here, this up in the left corner, this was the first imbalance that took out this low, right? And so when price finally goes above it again, it does not retrace into it, stops right here, closes below, and uses that resistance once more, goes lower. Once again, every single time, it retraces here, gets used as a resistance, and goes lower. Same thing here, 3 times, does not displace. And then you get a beautiful example right here, 9 o'clock. What do you see? Perfect wick up into that imbalance on the left side. Did not even take out any liquidity here. All it had to do was reach that imbalance, taking out this daily high, and boom, just rejects and goes lower. If you manage to find the correct PD arrays on the left side and you're able to zoom out and find your correct point of interest, you're going to see these very precise reactions. And it's definitely a very nice thing to use, because most people would not look at this imbalance. Maybe they would consider this one, or maybe they would consider this one. But the thing is, this one you can also use. It lines up with the old one, right? And you can see same reaction, but it works because it lines up with that same area as this one. That's why this imbalance formed where it did. Price is showing to you the areas of interest, points of interest as we call them, and we simply highlight them with PD arrays. Now, in case you wanted a lower time frame example, I found one right here. You can see we have an imbalance that formed right here on the 1 minute chart at the very high. And this was the first imbalance of this entire move lower, right? This move took out this low, the London low. And you can see on market open, price goes into it, finds resistance, goes lower. Same thing here, price takes out the high, does not take out this high, finds resistance in here, can't close above, goes lower again. Same thing here again, price cannot break this area. So it's literally showing you that price is not bullish enough to take out this high and to break above this imbalance. Now, of course, it's also a nice confluence that it formed exactly where another imbalance formed. So it displaced another imbalance moving lower. You can see that right here. That's one form of a BPR, and you can see price clearly used it here multiple times. Now you have to be careful with this on the 1 minute chart. Like I said, there's going to be a lot more of these, but in the end, you should be able to find something obvious like this to then combine with your higher time frame and decide what your point of interest or drawn liquidity is going to be. For example, this high forming right here, right next to this high, is a nice target for this run higher. Now, in terms of choosing the PD arrays that are freshly formed, that are not referenced before, for example, right here, you have the typical mitigation block, right? And you can see price comes into it, uses as support, goes higher. But you didn't even have a chance to see if it was used before, because as you can see right here, price just used it once and then went higher. The one exception where you can actually use this is when you have a valid point of interest using the same logic that we talked about on the hourly chart at that point, because you know that once you actually start forming the bullish PD arrays from that bullish higher time frame PD array that has already shown that price is interested in, you anticipate those PD arrays to work. At this point, you should not care about any of the imbalances that are on the left side. Everything on the left side is going to be displaced until we reach our target. So we have to combine the higher time frame by waiting for price to reach the point of interest. It's then going to start forming the bullish PD arrays, or bearish if it was a bearish point of interest. And these PD arrays should now start functioning as support on price. Another confirmation, as you can see right here, this formed just at the end of the macro, 10:15. That would be 9:45 till 10:15. That's one macro. And so the PD array that formed at the macro, if it's at the valid point of interest, this one should hold, even to the point where you can literally put your stop below here or here. I hope you now got a better understanding of why I choose to highlight the arrays that I do, and how you also can use this logic for yourself to potentially frame points of interest or areas in general where you anticipate price to react from. So with that being said, thank you for watching, and I will see you in the next one.